Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. It's been a kind of a toasty week here in the Coachella Valley, Greater Palm Springs area. Been hovering around the 90s, even breaking through 100 degrees. Pretty warm days for early mid-April. Got a lot going on here this month in particular. It's kind of our last big push for tourism here in the valley with, of course, a couple of festivals you may have heard about, the Coachella Fest as well as Stagecoach. So a lot going on here and a lot of people here and enjoying the Coachella Valley and all it has to offer. And looking forward to this weekend. I talked about baseball here a couple of weeks ago, and of course my Angels surprisingly have a winning record, a pretty good winning record. And then of course we've got the Masters golf tournament starting today, and I'm looking forward to the car races, the Long Beach Grand Prix this weekend in Southern California. So anyway, with all that, let's go ahead and get into an update on the markets, the bond market and the mortgage rate market. As we like to do, we're going to pull up the rate grid here. Jeff's going to show it to you. And with all of the hand wringing, all of the trauma, I'll call it, of the tariff wars, I think we need to kind of keep this in perspective. Now more than ever, I would urge caution when reading the headlines. They're a little bit exaggerated into all that's going on. I mean, no question, it's been very volatile and there's been some very big swings. I'm not disputing that, but in the context overall of where we're at, it's not like things have fallen off a cliff. You can see from our rate grid, we updated this earlier today, mortgage rates are still hanging in there. We're still in the sixes. Now, yes, we were down to closer to six, even breaking that six barrier almost a week ago, and it's kind of come back up. But these rates that you're looking at now on our rate grid, these are all at a level that we were at just literally less than a month ago. So it's not like what's been going on here with these tariffs. And I certainly don't want to get into any of the political issues associated with that, but it hasn't been hugely damaging to mortgage rates, as you can see from that screen. And then when you look at the 10-year bond chart, of course, you're going to see here the kind of trend upward that we don't want to see, obviously. And late last week, again, this is a 5-day chart, goes back to last Friday. Late last week, I mean, the 10-year bond was under 4%. So we were kind of in the industry bracing for, okay, we got another shot at a refi boom, right? Well, that quickly dissipated literally within a day or two, and here we are back at these levels in the mid sixes. So again, overall though, especially if you're looking to purchase a home, it's not the end of the world. I think things are going to be somewhat calming down, and we'll just have to see how that goes. So yeah, it was a quick dip back up to sort of levels we've been seeing for most of this year, frankly. So from that perspective, hey, keep your head up, keep positive. I think hopefully we'll get through this relatively well. Some things going on in the financial markets that has led to these kind of numbers, both in terms of bond yields and mortgage rates. Well, as I put on our little cheat sheet here, our little list of subjects, more tariff uncertainty, that's continuing. And there's a lot more. We had these tariff announcements done last week, and then yesterday they're going to be put on hold for 90 days. We're back and forth with China. So that's creating all kinds of consternation, hand-wringing, and concern. That's really kind of overwhelmed, I think, the markets, both the bond market and the stock market. In terms of data points, actually not a whole lot other than mostly inflation information, which I'll touch on here in just a second. Earlier in this week, though, the Fed minutes were released from the last Fed meeting. And what came out of that is concern about stagflation. That's where you have a combination of higher inflation and slower growth. Because you know what? With all these tariffs and all the tariff talk and headlines and so forth, there's a big concern about the tariffs are going to be inflationary. So, but yet at the same time, recessionary in terms of people losing jobs and so forth, at least in the short run. And so what the concern now is stagflation, where you get sort of the worst of both worlds, prices going up and growth slowing, and maybe even we go into a recession. So that's part of why the bond yields have been elevated this week, just because of those minutes being released. And then today, or actually this week, the CPI Consumer Price Index was released today. The PPI is going to be released tomorrow. That's the Producer Price Index. That's the inflation number at a wholesale level. Well, in terms of the CPI number that came out today, guess what? It was better. It dropped. And in fact, it's the lowest it's been since March of 2021, year over year, 2.4%. That's pretty close to the Fed's target of 2%, right? So despite that good news, bond yields are still being a little bit elevated because now the narrative's changed to, rather than just accepting that good news that inflation dropped in the most recent month, it's, oh, well, that's good, and the but is, but that's going to go away because of the tariffs. So there's this sort of thinking out there in the markets about, not enjoying the good news as with the CPI number and worrying about what's going to happen in the future when we don't even really know yet what's going to prevail. So that's a little bit of the psychology going on in the markets, I think. The producer price index is tomorrow. It's also forecast, actually in this case, it's forecast to be slightly up. If it turns out not to be that, if it doesn't come out that way, remains flat or drops a little, that should help us and kind of keep that 10-year bond from getting too crazy. Now, the other thing that's been going on is Treasury bond auctions. Occasionally, Treasury has to sell Treasury securities, and there's been some of that here in the last few days. That's had an impact on bond yields too, because the sale of those bonds has been a little lackadaisical. The other concern about bond yields is what's going to happen with international investors, i.e., in particular, China. They own a lot of U.S. debt. They own a lot of U.S. treasuries. So there's concern that as part of this war on the tariff issue, that they may decide to start selling some of the treasuries they own, or stop buying some of our treasury at auctions, which of course could push yields up further. So that's also weighing on the bond market in terms of where the yields are at. But again, I would urge caution, calm down. All in all, mortgage rates are still hanging in there pretty good. And in particular, on the purchase side, with the use of buy downs, both temporary and permanent, we can help you get into a home at a pretty reasonable rate level. And refis, yeah, maybe less so going to happen in the mid sixes, but I think we'll have another shot at those refinance transactions, at least a lot more of them in the relatively near future. So with that, I'm going to bring Jeff on because we've got a few interesting things to talk about as it relates to the financial markets and reverse mortgages.
Hey, Art, how you doing?
Good, Jeff. How are you?
Good. I had to pull myself away from the Masters. One of my favorite, Justin Rose, is on a roll, and it's kind of nice to see because if he were to win, it's early, of course. He's led the Masters before and not won, but he would be the oldest of record, so that would be kind of cool. And yeah, so it's kind of neat.
Well, heck, that could be inspiration for you to get back on the tour.
Yeah, maybe if they allow wheelchairs or a golf cart, I'm in. So,
okay.
Yeah. So anyway, so yeah, I wanted to ask you about this a little bit. I heard something today. In fact, because people know I do this show with you kind of behind the scenes a little bit and have interaction, they're always sending me these headlines, and the headlines are never positive. Right. It's always the worst. And then when you dig into it, even if you read the actual article, it's like, well, why didn't you say that as a headline? Well, because it's not catchy enough. It's not dire enough.
Right.
And so my friends I always have to kind of rebut them and say, hey, this is something that really is within that process. And you just absolutely hit the nail on the head. It's like, can we never find something good without a but? It would just be really nice.
Right. It's so true, and that's why. And too many people, that's all they do is read the headline. They don't dig into that article. And I've told you before, especially now, because a lot of these articles online will tell you how many minutes of a read it is. And I am convinced that if somebody sees 8 minutes, 10 minutes, you lost them. They're going to stop at that headline and move on. So
yeah, I totally agree. Yeah. Well, I think one of the things that for me, you can tell somebody's just a headline reader, because if you ask an additional or follow-up question on it, they got nothing.
Right.
There's nothing there. So anyway, moving on with that, something I'm having a little fun with this. It's a retirement strategy for senior homeowners, which requires no magic wand, no sleight of hand, or pixie dust. And so I'm putting that pressure on you because, hey, let's face it. When you think about a senior homeowner, what are they? We're relying on things like our investments. And when we see this, this swing in the market, as we've seen this week, gets people a little nervous. So I'm interested to hearing what you have to say when it comes to this whole idea of strategy for senior homeowners.
Sure. In fact, I'm going to touch on something that I think we covered or discussed a little bit about reverse mortgages, several months ago. But this current kind of wild ride we've been seeing in the financial markets reminded me of how important senior homeowners um, should consider a reverse mortgage um, to be a integral part of their financial planning. So often there's still this notion that a reverse mortgage is sort of this loan of last resort, or that it's primarily just for someone who maybe has owned a home for many maybe decades. They paid it off, but they're low to moderate income folks and don't have a lot of recurring monthly income once they retire, and so they're a little bit concerned about having enough money to live on. And a lot of times we end up with a reverse mortgage customer where they're in that position and they've kind of used up most of their liquid assets, and they're kind of using this reverse mortgage as a last resort. So that's certainly a key part of a reverse mortgage target audience. But there's this whole other type of senior homeowner who may be much better off financially, may own a home that's, again, free and clear or very nearly so, but they've got a lot of money invested, and both in retirement, maybe non-retirement accounts, and fully invested in the markets. And what we see is in those cases, they may have some retirement income recurring, whether it's Social Security, or you don't see pensions too much anymore, um, but they may be, and because of that, they may be using their, at this point, very extensive financial assets, and maybe setting up withdrawals on those assets in part to live on. And we particularly see that when for homeowners like are aged in the 70 to 80 range. For example, at 70, you've got the RMD, required minimum distribution, that kicks in for your IRA accounts. Well, a lot of times that involves not just taking the required minimum, but setting up a recurring monthly to live on. So if for a homeowner like that, in this kind of environment, it underscores why a reverse mortgage can help preserve that portfolio of liquid assets. Because here's the problem. Let's say you got $2 million in an IRA account, and you're drawing $6,000 a month from it. Well, the problem with that, and that may work well for maybe a long period of time, but when you have a type of correction that we've seen this last couple of weeks or week, what happens is that that portfolio is starting to draw down because of the market decline, while you're still pulling money out of it, which accelerates the decline. And that can really set you back to where even when it recovers, if you're still drawing that money every month, you're going to accelerate the period of time before that money runs out. So that has to do with what we call sequence of return risk. And so for that kind of homeowner, what they ought to consider doing is, even though they think, oh, I don't need a reverse mortgage, I'm not poor, or I'm not low to moderate income, they should consider getting that reverse mortgage secured by their home. And one of the great features of the core reverse mortgage, and most of them now, is being able to set up a line of credit. So you can get that loan in place, get the line of credit set up. So then if you've already got that in place, and then we have the kind of downturn we saw here in the last week or so, you can basically stop the withdrawals from your portfolio, replace that withdraw from your line of credit in your reverse mortgage, and continue that until the market settles down and your portfolio balance is recovered from that major dip. And again, we're talking about, like we've seen this past week, we almost got to bear territory. The stock market's been down about 15% just in the last week or so. So in that kind of extreme scenario, it would make sense to stop drawing from that portfolio, instead draw from that line of credit in your reverse mortgage. And in fact, the overall strategy dictates, look at your portfolio from year to year. If it's down, pull from your HELOC. And then next year, look at it. If it's up, then you can transition back to pulling from the portfolio and leave the HELOC alone until you need it again when that portfolio is down. And just do that from year to year. What that proves is that you can end up overall maximizing or optimizing the total amount of your accumulated wealth between the remaining equity in your home and preserving that portfolio by using the HELOC to preserve it. So it can really work very, very well. And we actually have a presentation for financial advisors. And I would encourage anyone who would want to know more about that, contact me and let me know who their financial advisor is. And I can send this to that advisor who can then sit down with that homeowner and explain this strategy to them.
Well, Art, something that it just kind of occurred to me is, when you were saying when it's down, I was thinking you were going to say, well, okay, you can take from that HELOC, or excuse me, the reverse mortgage, and replace that loss in your retirement account. Then I thought, well, maybe that's, and then when you said that, I thought, well, wait a second, isn't there another benefit of, I think it's like robbing Peter to pay Paul, but it's really not like that, because even though one may be going down, what's going on with the value of our homes?
Well, good point. I mean, of course, any reverse mortgage proposal package that we provide to homeowners, it uses, I think, some fairly conservative assumptions about things like home value and increase in equity over time. In fact, the standard approach in these proposals packages, and remember, everyone, we're talking about the core reverse mortgage product, the HECM, home equity conversion mortgage. It's a FHA loan. So there's extensive disclosures about how this product works. And so the idea is that, with the HECM reverse mortgage, you can use that to, you could draw on the line of credit that you've set up on that and pay replace the lost funds from drawing on your portfolio account. I would argue that's probably not the best approach. You're better off using the line of credit on the HECM to replace the money you were drawing to live on. That's a better, I think, a better execution financially of how to use the HECM in relation to your portfolio, because what you're trying to do is optimize the value of your portfolio, prevent as much of a decline in it as would otherwise occur if you didn't have the HECM in place to help support that.
Well, you've shared with us over the last few weeks, even though the market, housing market may not seem as robust as it was, just a few years ago, but home values are still growing at a fairly steady rate, are they not?
Well, they are. I mean, as I was saying earlier, the assumption in most HECM disclosures is a 4% appreciation rate per year. So, and one of the things that these disclosure packages show is how even as you draw on that reverse mortgage, and if you're not making payments on it, even though you're allowed to if you want, it's going to show you how that reverse mortgage balance is going to grow over time. But at the same time, it's going to show you, using that 4% appreciation assumption figure, how much your home value is increasing over that same period. And what's remarkable is your home equity position remains relatively constant for a pretty long number of years. And in most cases, the balance will not exceed the home value, at least not until you're probably not around anymore. In other words, and they use up to age 100 when they prepare these proposals. And so and what's important about that is, particularly if you're a homeowner starting with a free and clear home, and you're setting up this HECM to use as a financial tool to preserve your portfolio, again, you can take a minimum draw of that reverse mortgage loan amount available, set it up as a line of credit so that you're initially having a pretty low impact on your equity position because you haven't drawn very much of the total amount available, and that you will do that gradually over time, again, as a strategy to replace your portfolio withdrawals, and do that for a limited period of time and then switch back. So that kind of strategy where you're kind of gradually using the reverse mortgage amount available combined with that 4% appreciation rate, you're going to be in pretty good shape, probably at least up to and past your likely mortality anyway. And that's what these disclosures show.
It sounds like this is a great solution. It's like having a safety net that is there, and you only need it if those wild swings we're seeing in the market that, let's face it, a few points here and there are not a big deal, but 15% is pretty substantial. That then you say, okay, let me go to plan B. Let's leave everything there. Let's not take any money out. And then let's use our our reverse mortgage, our line of credit for that monthly income for, let's say it happens 2 or 3 months in a row. That's still a very good strategy, it seems like.
Well, it is. And see, one of the things about the reverse mortgage and its line of credit feature is that, yes, I think it's an excellent way to have that sort of rainy day account, because a lot of times that's what people will think about when they try to want to just get a regular HELOC, for example.
Mhm.
And it wasn't too many years ago that we routinely did that. Back 15, 20 years ago, certainly before the '08 crash, if people came to us with a HELOC, we could set that up for 100,000 or 150 or 50 or whatever the number was, and they would be allowed to. We'd close the loan, and it would sit there. They hadn't drawn against it, but they wanted it there in case they needed money later. Well, the equity lenders figured out that was a flaw for them, and the reason was, if they're going through all the upfront work, bricks and mortar and everything to get this loan arranged and closed, but they don't draw against it when they close the loan and they let it sit there, the lender's not making any money because there's no balance. So now if you want to get a HELOC, most HELOC lenders, you're going to have to draw some minimum amount, in most cases 50 grand or 75% of the line of credit amount, because the lender's trying to force you to take the money. Don't just get the account and let it sit there, because they don't make any money on it. So they're forcing you to take that draw so they can start earning the interest yield. Well, see, and to me, and the market's kind of absorbed that change, and it's understood for the most part. If you're a senior homeowner, you have an advantage if you still like the strategy of having a rainy day fund to access when needed. The reverse mortgage gives you that, unlike the traditional HELOC, because you can take a reverse mortgage. At closing, you can draw a minimal amount, what we call mandatory obligations, which would be your current property tax installment, maybe your homeowner's insurance that's coming up for renewal, so 12 months for that. Maybe you have a small mortgage of 100 grand or something, so you pay that off. But let's say, depending on your home value and your age, you may have $400,000 of reverse mortgage available. So you take that minimal mandatory obligation draw at close, set up that line of credit after the first year, and there you go. You've got maybe 250, 300,000 in a line of credit. You're not required to draw on it. You can let it sit. So it's there as your rainy day fund. And then the even better part is, unlike a traditional HELOC, that reverse mortgage line of credit, the unused portion grows over time in terms of the credit limit. So you're going to end up having more access to that line of credit over time, based on whatever portion of it you haven't drawn against. That unused credit grows over time. So that's a terrific benefit that most folks don't realize. So if you're a senior homeowner and you're free and clear, or nearly so, and you're 60, you got to be at least 62 or 65 or 70, 75. If you're thinking HELOC, think of a reverse mortgage. I think it's a very good alternative.
I like that. Well, Art, I want to switch gears just a little bit, if you will, because unfortunately, there are still some myths out there, or let's say misunderstood things about a reverse mortgage. And one of them is, what happens to my home and the loan balance when I pass away or move out permanently?
Yeah, the basic idea with a reverse mortgage is the loan has to be paid off. In fact, technically, the loan is considered in default when the last borrower has passed away or has left the home for at least 12 months or more. So it's either passing away in most cases, or if you end up having to vacate the home because maybe you have to go into assisted living full time. So you're no longer able to occupy the home. That causes technically a default. Now, that doesn't mean when that event occurs, the bank swoops in and takes your home. Doesn't work that way. The heirs, the family, whoever the survivors of that person are, they do have to make a decision about what to do with that reverse mortgage. It does have to be paid off. But what people should understand is you will be given options as to what you can do. And I went through this. I've talked about on the show. Did a reverse mortgage for my dad in 2006. When he passed away, I had to deal with this. Well, what happens is, well, first thing I'll tell you is, believe it or not, the lender will probably know very quickly if it's a last borrower passing situation. They'll know very quickly if that occurred, even if you don't call the lender and tell them. They have their way of finding out. When that happened in my case, I hadn't called the lender yet, and literally within a month after my father passed, his next monthly mortgage statement for the reverse mortgage, I noticed on the envelope it didn't say William Alvarez, it said estate of William Alvarez. So I thought they were aware he had passed, even though I had not called them and told them that. So they have their way of knowing that, by the way. So just so everyone knows that. But then what they do, you're going to get a letter in the mail, and it's going to give you multiple options as to how to deal with the fact that this reverse mortgage is now quote unquote due. You can deed the property back to the lender. That's allowed. You can say, I don't want the house. I just want to record a deed and give the house back to the lender. That's an option. You can sell it. You can sell it on a short sale. You can keep the house and refinance it. You could, keep the house and just pay it off because you have other financial assets to do that. So you have multiple options, and you do have some time to decide which one and get it done. The key is you do have to communicate with the lender. You have to maintain that communication. Let them know which of the choices being provided is the one that you're likely going to pursue, and then keep them informed as you make progress toward the end goal of getting that loan paid off. And in some cases, all it entails is you look at the choice and you say, and especially if there's multiple family members who are going to benefit from inheritance of, say, this property, a lot of times it ends up being, hey, there's equity, maybe a lot of equity still, even with the reverse mortgage, and we're just going to sell it. And so you just keep the lender involved and aware of you going through that process, and they'll allow you the time to complete that process before they do anything. And all they would do is, if nothing happens, they don't get communication from the heirs, I mean, they can start a foreclosure process just like a regular first mortgage where you default on making the payments. It's the same process because it's a loan like any other. And so as a consequence, they can pursue foreclosure, but in most cases, the cure of getting the loan paid off is done another way.
So again, it sounds like it's not a very fast, like, hey, you've got 24 hours to make a decision.
No.
And because I guess if one of those decisions, hey, you want to sell it, it takes a little bit of time to get on the market and start marketing the property. They're just, as you say, the key is communication.
It very much is. In fact, again, using my case, if you have a home where the reverse mortgage borrower passes, and the home was held and vested in their living trust. Well, one of the things you have to do for anyone who has a living trust is, after the trustee passes, there's a step you have involved where you have a 120-day notice to potential beneficiaries, because a living trust is going to have beneficiaries named. But if it's a large family, there may be some family members who feel that they should have been a beneficiary. And so you have to go through a process. And this is all the estate planning stuff. You have to go through a process of, okay, this person who had this living trust has passed. We now have to send written notice to all of the potential beneficiaries in the family, alert them of this, give them 120 days to respond and ask for a copy of the trust, and allow them to make a claim that they should be a beneficiary. So I had to do that. So I was just letting the lender know, hey, look, we intend to sell the house, but here's the first step we have to do. And then after we get through this step, I will, we'll go to the next step, show you, send you a copy of the listing and so forth and so on. So you can get the time to do all that. You got to keep them informed.
That's nice. Well, that makes sense, especially if you happen to be out of the area to put all this stuff together. One of the next things that people are concerned about is, if I do a reverse mortgage or a HECM, then I don't know my own anymore. Is that true?
No, it's not. Another very stubborn myth out there. Again, and I can't even remember now why that ever became a belief, but the reverse mortgage lender does not own your home when you get the loan. The reverse mortgage lender has a security interest in your home. And that security interest is created in California by a recorded deed of trust. In other parts of the country, it's established with the recording of a mortgage. And of course, we use mortgage as a generic term for either type. So, you know, if you're 70 years old and you go get a loan from Wells Fargo, just a traditional fixed rate first mortgage, that doesn't mean Wells Fargo owns your home. They're going to record a deed of trust for that traditional first forward mortgage that you're going to make payments on. And so they're going to secure their interest by recording that deed of trust against the property. And then, of course, if you don't make the payments, they have the ability to start foreclosure proceedings and take the house from you. Everyone knows how that works. Somehow what got lost in the rollout of reverse mortgage decades ago was somehow the not understanding that it works the very same way. So you get a reverse mortgage, there's going to be a reverse mortgage deed of trust secured by your home, recorded against your property. That's their secured interest. And they're not going to do that doesn't mean they own the home, you own the home. And they're not going to do anything to your home or try to take it unless you pass away or you vacate for 12 months. And then there is the process we just discussed about how to do that. They don't just swoop in and take your house in 24 hours.
Sounds like it might be another one of those headlines that, was passed around a campfire, and next thing you know, we think it's the truth.
Right. Exactly. Yep.
All right. So the next one is, are there any risks or downside one should be aware of before choosing a HECM?
Not a whole lot. Of course, I would want to just say, in terms of risk, you want to consider, there's always the risk of the timing of when you get a reverse mortgage, what happens to the markets in the future. And I'm talking not just, the housing market necessarily, because obviously the housing market to a large extent is going to be affected by the financial markets. So the point of that is you're always going to have the risk of an 08 situation. If you got a reverse mortgage in 06, and then we all know what happened in 08. Well, that happened in my father's case, again, bringing him up. When we got his reverse mortgage in 06, his home was worth $440, and we got him a reverse mortgage of about $250. He was 80 years old. By 2009, that $440 valued home was down to about $250. So in 2009, 2010, his reverse mortgage balance was already equal to the value of his home because it had dropped. But he still was alive, still living in the home. Everything's good, nothing to worry about. And he had that loan for 14 years. And guess what? The home value was back up over $500,000 at the time that we got it sold. So that's probably the biggest risk to be concerned of, but it's pretty rare. 08 situations don't happen very often. Otherwise, what I would mention is be aware of a couple things. You are going to go through a financial assessment in getting a HECM. There's no debt to income ratio per se. There's no credit score requirement or minimum per se. A couple of hot buttons, though, is you want to make sure you're paying your property taxes and your homeowner's insurance on time. Those are looked back for 24 months. And if you don't pay those on time, that is a problem. It's addressed by setting up what's called a life expectancy set aside. So they take some of your proceeds that you would normally get from the loan, set it aside to make sure the property taxes and insurance get paid because you've demonstrated an inability to pay those on time. And with the Home Safe Second product specifically that we've talked about, if you're late on your property taxes or homeowner's insurance the last 24 months, you're declined for the Home Safe Second. You're not allowed to get one. So be aware of that. You do have to maintain those property-related expenses because that can essentially trigger a default of the reverse mortgage as well. And so that's important to understand that even though the mortgage portion of your housing expense is gone, those other related expenses you still have to cover.
Wow. Well, last, and I think you've kind of covered this a little bit, but just to kind of recap this is, how can a HECM be used proactively instead of just a last resort?
Yeah, as I did touch on earlier, that's where I think I see people make the biggest mistake, is the reverse mortgage, I think, still too often is looked at as the last resort and not looked at earlier, or when the senior homeowner is, over the eligibility minimum, but maybe not way up there in age yet. But they've got that good situation where they're free and clear or nearly so. They don't think in terms of how the reverse mortgage is not just a last resort, so I have something to live on until I pass away product. It is a very viable and can be a very good strategic financial tool to use in combination with managing your other financial assets. And if you've got a good financial advisor, you and that advisor should get together and look at this loan product. Again, in cases where you're free and clear or nearly so, you've got substantial liquid assets in your portfolio, the reverse mortgage can really, really help the growth of that portfolio and maintaining its value even in downturns like we're seeing recently.
Well, Art, I think I really appreciate you kind of clearing this up and really once again explaining, really how safe it is. I want to make sure I understand this. So a HECM is actually an FHA supported product?
Right. The home equity conversion mortgage is an FHA loan. So it is a federally insured loan. In fact, that's one of the things we always try to remind people, because one of the objections to a HECM reverse mortgage is the mortgage insurance. It's deemed to be very expensive. But what I always remind the senior homeowner is it's well worth it, because recall that we've talked about this before. The purpose of the mortgage insurance for the FHA HECM loan is to provide that homeowner and their heirs the benefit of non-recourse. So if you do get this loan and you do end up getting hit with the risk of your home values drop so much that the reverse mortgage balance exceeds your home value, and then maybe you've passed away, your heirs are looking at it going, the loan's $400,000, the house is worth $300,000. What do we do? Not to worry. Non-recourse means the family, whoever inherits the house, is not responsible for the deficiency balance in that scenario. That's what the mortgage insurance covers the lender for. They submitted a claim to HUD, which is part of, FHA is part of, to get reimbursed for that deficiency. So they can be kind of reassured that they're not going to be having to deal with that in that particular scenario.
Hey, it's great. Art, I'm going to put your information along the bottom for those of you who would like to know more about your situation, or as Art had mentioned, hey, get a hold of your financial advisor, because he has a presentation for your financial advisor to explain how this can be done. His information is down below. His email is art@mwloan.com or 760-969-5023. Give him a call. Art, again, thank you so much. I really appreciate that. It is a tool that sometimes we don't realize we have, but we have a home that is either free and clear or it has loads of equity, and we're not sure how to get to it. This is a great way. Art, Thank you so much. I appreciate it. Have a great week.
Okay. Thank you, Jeff. Well, okay. Thank you, everyone, for watching this week's Mortgage Minute. Appreciate your viewership. Have a great weekend, and I look forward to seeing you next week on the Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.